We got 4 or 5 years. Now, there's plenty of returns to be had. Yes, crypto's been slower in the last couple of years. Bitcoin still outperformed the Nasdaq since the liquidity low in 2022, and it will have its time in the rotation again. But overall, this is the bet. It's the only bet there is. This is the big one, and we need to pay attention because this super cycle means we won't have a bear market or a recession or something in 2026, 27 or 28. It just can't happen. The expenses of the capex is just too big.
Everyone has seen those AI commercials. The employee who spends 3 days building a report, only for someone using AI to finish it before lunch. The veteran who's been doing the same job for 15 years, suddenly competing with someone who has an AI assistant that works 24 hours a day. Or the business owner who discovers that what once required an entire team can now be done by one person with the right software. They feel exaggerated until you realize they're pointing towards something much bigger. They're not really selling AI. They're warning you that the rules of the economy are changing faster than most people are prepared for. Raoul Pal believes we're witnessing the beginning of the biggest investment opportunity of our lifetime. Not because another speculative bubble is forming, but because artificial intelligence is becoming the engine behind an entirely new economic system. In his view, AI, robotics, energy, semiconductors, and compute power aren't separate stories. They're all feeding into one massive supercycle that could reshape productivity, corporate profits, financial markets, and even the way governments deal with debt. If he's right, investors aren't simply buying another trend, they're buying into a structural transformation that could last for years. Today, we'll break down Raoul Pal's complete supercycle thesis. Why he believes artificial intelligence could unleash the largest productivity boom in modern history, how that productivity may help economies grow out of today's debt burden, and perhaps most importantly, how he believes ordinary investors should position their portfolios before this opportunity becomes obvious to everyone else. If you enjoy these deep dives into macro investing, Bitcoin, AI, and the future of global markets, don't forget to like this video, subscribe, turn on post notifications, and let us know in the comments whether you think we're witnessing the start of the AI supercycle or another technology bubble waiting to burst.
So we know that the semis lead the intelligence index, and that leads capex, because as intelligence starts scaling, they have more confidence in capex, and we're starting to see capex, and then following it is productivity, which is really what we need to see moving. Now here we've got total factor productivity, which is a much slower measure, and this is like a 5-year average as well, and it's the domino that's not really started moving. But that's the one I think moves, and that's the one that everybody needs to move, because if we increase productivity, we increase GDP growth, we lower inflation, and this whole game continues to hyper accelerate. And that leads us into the economic singularity. That's when all of this comes together and its outcomes are as expected. So that's GDP growth. Now, under the new magic formula, is humans and robots plus AI, plus productivity and debt, plus energy density and compute efficiency. Those are the sort of productivity outputs of the exponential age. This is where things change, because we can now put infinite workers into the population. The robots and the AI in robots that people are forgetting about, we're going to put AGI brains in physical robots, and they're going to be essentially a new species, which people aren't ready for, but that's coming. But even just the rise of the agents is enough to start generating GDP growth, and the robots will do more. Obviously, productivity of an aging population, not great, but the productivity of these new populations, very good. Energy density, this is the big race where you have to lower the cost of energy. This is the race to solar. This is the race to nuclear. And this is the race to lower fossil fuel costs via freeing up all of the trade structures, whether it is the friction of Iran or the friction of Venezuela, whatever it may be, everything gets cleared because this is the race, and compute efficiency does the rest. And that is how we solve the world's problems. Because what we do is we accelerate GDP growth, debt to GDP collapses like it did in the 1950s. But what does the system look like on the other side? So once capex starts growing, once productivity starts growing, we've got our answer. So here is the BLS measure of productivity. Now, Walsh has said he doesn't like the measures of productivity because they're not very good. I agree. And they will find another one and they will show how compute is driving productivity. But here we've got the total factor productivity, the funnel model, and we've got the BLS model. The BLS is turning up. Let's see it accelerate. If it accelerates through sort of 3-4%, then we're into the big game. So we're waiting for the final confirmation that productivity is going to pick up. If productivity doesn't pick up, then this game of intelligence would be a disaster. But I cannot see a world where it doesn't increase productivity, much like the internet. And it should be much larger than the internet. And the internet did. Productivity was super strong in the late 90s, and it should be even stronger this time around. But there's a lag. Things take time. We've only just started this game. So I think we will see productivity accelerating, and productivity accelerating brings rates lower over time, increases GDP growth, allows for ongoing financial repression where GDP growth grows faster than interest rates. It funds the whole system. We have enough earnings from the corporations to drive this. Now, we know it's not going to be completely unilaterally positive, obviously, because we've got whole frictions and sections of the market where people of the economy where people will not benefit as easily, but others will. But over time, the bet is this is the largest deflationary force of all time. And if it is, and it becomes vastly deflationary, then finally people's real earnings will be growing and people will feel richer. And we've not had that for a very long time, and we desperately need it. And this is the only answer I can come up with. Subsidy payments and all of that stuff doesn't work in the same way as generating a massive rise in productivity that collapses inflation to disinflation, where we have abundance in goods and where earnings cover all the needs that you have. It sounds optimistic. The path there, it's not easy. The path there is political. The path there is sectors of the economy slowing down. The path there is whole parts of the economy not wanting to accelerate, other parts wanting to accelerate, the political battle that means, what it means for people, how they feel disenfranchised or enfranchised. It's a complicated world, but it should work.
For Raoul Pal, this entire thesis rises or falls on one critical metric: productivity. Faster chips, larger AI models, and record-breaking capital spending don't matter unless they eventually make workers, businesses, and entire economies dramatically more productive. That's the missing domino he believes is only beginning to move. Once it does, higher GDP growth, lower inflation, stronger corporate earnings, and healthier debt dynamics all become part of the same reinforcing cycle. In his view, AI isn't simply another technology upgrade, it's the catalyst that changes how the global economy functions. That naturally leads to the next question. If productivity really does accelerate at the pace Pal expects, what does that mean for financial markets? Does it simply create another investment boom before the inevitable crash? Or are we looking at something fundamentally different? This is where Raoul makes his boldest prediction yet, arguing that the traditional business cycle itself could be changing as intelligence becomes the world's most valuable economic asset.
So let's go back and talk about this again, the supercycle. I don't think there's a bust. This is a phase change. Debt, it now is the new mechanism to fund compute. Debt servicing ability in the private sector is the largest it's ever been. So they will use debt. That is an increase in liquidity. The government continues their liquidity injections. The compute that gets built becomes productivity, and the productivity allows the economy to outrun the debt. Rail, electricity, and fiber all ended the same way. The debt compounded faster than revenue. So we don't want that to happen, but we're going to have to see. Because of the speed of this and the speed of the double exponentials, the asset of intelligence and compute should compound faster than the interest payments. That's the big bet here. It's very different than the other boom busts. Now, they were real booms, and they lasted a long time. There were some busts too. But that technology didn't go away. Just some of the players did. And we had a phase change. So I think over time, this is not going to be a bust. There is a probability there are sectors that may suffer, but overall the game is too big for anybody to let it fail. No nation state can allow it, and no firm can allow it. There's plenty of room for it to be funded via debt growth. The government is doing its part, and productivity will do the rest. And that is where we're going. And then eventually we get to the point where money stops being able to measure what the new system produces. Because we won't even see this economy. It's an invisible economy of agents and robots that we're not even part of half the time. How do we benefit? Well, we're going to have to figure that out. All I know is we have to lean into it. We have to lean into this because the entire world is organizing itself around intelligence, and everything is downstream of it. All of our investing is this. All of our time, we all need to go up the curve. You can't be left behind in the great race because you will be truly left behind unless you choose to opt out of it, which is okay too. But everything is happening at the fastest speed. It's hard for us to keep up. It's hard for us to even focus on the amount of changes that we see every day right now. And again, it's only going to get faster. So the way to deal with it is be part of it. Be part of it, invest in it. At the dumbest level, if you fear the robots and the AI are going to take over your jobs, you might as well invest in them. Because if not, what are you going to do? Angrily shake your fist at the sky while your job gets replaced and you haven't made a plan? And that's been the plan for me, and I've told about this for a long time, is your future, and how few, we got 4 or 5 years. Now there's plenty of returns to be had. Yes, crypto's been slower in the last couple of years. Bitcoin still outperformed the NASDAQ since the liquidity low in 2022. And it will have its time in the rotation again. But overall, this is the bet. It's the only bet there is. This is the big one. And we need to pay attention because this super cycle means we won't have a bear market or a recession or something in 2026, 27 or 28. It just can't happen. The expenses of the capex is just too big for that to stop. The amount of liquidity is too big for that to happen. Yes, we will have market corrections. Yes, we will see the semis down 50% at some point, maybe trading sideways for a year, but other parts will be hyper accelerating because all parts of the intelligence curve take off one after the other and keep rotating through as intelligence powers through and the energy efficiency powers through the economy.
Whether you agree with Raoul Pal or not, it's difficult to ignore the scale of the transformation already taking place. Governments are racing to secure energy. Technology companies are spending hundreds of billions of dollars on AI infrastructure. Nations are competing for semiconductor leadership. Every major company is trying to figure out how artificial intelligence fits into its business model. These aren't isolated events, they're all connected pieces of a much larger puzzle. The central idea behind Pal's thesis is surprisingly simple. Every previous technological revolution eventually increased productivity enough to create enormous wealth, even though many individual companies failed along the way. Railroads, electricity, automobiles, personal computers. And the internet all followed that pattern. This time, he believes AI could accelerate productivity on a scale we've never experienced before, because software, intelligent agents, and eventually robots can effectively create an ever-growing workforce that operates around the clock. If that happens, economic growth could begin outpacing the debt that currently worries so many investors. That doesn't mean markets suddenly become risk-free. Corrections will still happen. Entire sectors could struggle while others surge ahead. Some companies will disappear while entirely new industries emerge. But Pal's message isn't that volatility disappears. It's that investors should focus less on trying to perfectly time every correction, and more on making sure they're positioned for what could become one of the largest technological transformations in modern history. His concern isn't simply losing money during downturns, it's missing the wealth creation that accompanies a genuine paradigm shift. Ultimately, that's the challenge every investor faces today. Artificial intelligence may turn out to be overhyped, or it may become the defining economic force of the next decade. Raoul Pal has made his choice. He believes the greatest risk isn't investing too early, it's waiting until everyone else has already recognized the opportunity. As always, time will be the final judge. If you enjoyed this breakdown, don't forget to leave a like, subscribe to the channel, turn on post notifications so you never miss our latest market analysis, and share this video with someone interested in Bitcoin, AI, or the future of investing. Thanks for watching, and we'll see you in the next one.